Hey. So disclaimer, this is a learning video. I'm generally wrong with my analysis. So if you listen to me, you'll probably lose money. But here I'm documenting the understanding of my business, and probably this is for my own future reference. Okay, so the company that I'm going to talk about is Rico Auto, right? Sorry. Yeah, so the company that I'm going to talk about is Rico Auto. The key thesis for this business is, if you can see, yeah. So it's currently at 1.61 times machine turn, so which I calculate like sales divided by plant and machinery, and there could be a possible operating leverage as capacity utilization improves, along with some optionality in defense and railways. So there could be a possible re-rating. Underutilized asset, so around 40% of the casting assets are utilized, and so it can go up till 60, 70, 80%. And that's where the margin will start unlocking because the fixed cost has already been done. And these are capex which has been sitting in the plants for a long period. And then upcoming orders from the new Maruti, Toyota, Railway, and many other bunch of companies. And also there's a possible play in defense, fuse via a subsidiary called AAN, which is like Army, Air Force, and Navy. That's one of the subsidiaries. So in general, the auto ancillary has a couple of tailwinds going around. One is the GST and the taxes rationalization. Second is the revival of global demand and expansion of consumption and recovery because, yeah, export growth and global supply chain diversification. So one of the reason for ICE components, one big trigger is that a lot of technology is shifting from China to India, especially the manufacturing, because they don't have a domestic market to absorb that. And so it's prudent for a lot of auto ancillaries to shift their work from Europe and China to India. So that's playing out. Then government also has some policy push in terms of EV localization, EV and localization. So companies or big OEMs are asked or encouraged or pushed even to have a local vendor to create some sort of parts. And the good thing about India is now, on a quality point of view, we are probably at in the auto space, we are at the cutting edge as compared to any other auto OEM out there. So we have access to technology, machines, and everything, and also the skilled manpower. Premiumization, so that's also going on. So companies like SJS and all, because as we go up the aspiration ladder and access to EMI or cheap credit, or even access to credit is available, people would like to go up for higher. So if I would have bought a Hero Splendor, I would probably think about, if I could afford a Splendor at this point, I would probably think about a Enfield by just down paying a little bit extra. So that sort of thing. And then there's scale advantage and low cost engineering. So these are some of the big highlights of the auto ancillary industry, and we can see how it is in this bear market. This is one of the growing sector that is there. So I'll talk about Rico Auto business, as I said. So 47% of their business comes from engine, 16% from transmission, 28% from chassis and braking system, and 9% is from electric. And this is supposed to grow. This is where they were betting big, and this is where also the problems. So they are mainly an aluminum casting player, so 87% aluminum and 13% ferrous casting. We can go through the milestones. So they started in 1985, commercial production, die casting, and they have already from 1985 they have been with Japan and exporter to MEC Japan, etc. Because they were in the Maruti, that Manesar area, so they were already in the Maruti. 94 they got into clutches, then they got a lot of interesting customers and they were exporting them from 94 to 2003. They were into aluminium die casting, then engineering. 2004 to 2013, again they got into magna part and oil pump, water pump, aluminium oil wheel, and then they had newer customers like BMW, Toyota, Nissan, and Tata, Perkins, Magna, Renault, etc. And from 2014 to 25, um, so they added new plants in these places, improved or increased stake. Aftermarket business, Rico Friction. So that's where they got into. Non-auto business, railway manufacturing, CNC, S4 HANA, and then added new business for ICE hybrid, and also started constructing a plant in Hosur for Toyota, where Toyota is going to bring a couple of components from their existing supplier to Rico's this place. Okay, sorry. So these are the customers that they have, just to glance. And some of the components that they have for EV and hybrid vehicles. These are the cover housing differential, aluminium product ranges, uh, alloy wheels, ferrous products, so differential cases, exhaust manifold, bearing cup. And remember, differential cases go into both ICE and EV. That's their disc brakes and all of that. So any play in the ABS segment can really improve this part of it. Uh, So their plant location is spread across the country. So some are in South India, one is in Sanand. This was made for Nano, and these guys have got hit by a lot of bad lucks. I mean, Nano didn't pick up, but then Maruti they started serving from here. This is five, I think, Sanand 12-acre plant. Yeah, and then they have a bunch of cluster company over here with Gurgaon being the head office. And this is also a very expensive piece of land. And the company said that if they're and the company is willing to sell that land to, and that will just remove all the debt that they have in the balance sheet. They'll only do it if they see that post selling, and then they shift their plant and machinery somewhere else. They make a profit of 1,000 crore. And in the latest AGM, they have mentioned that a metro line is also coming up, so the value of the land will go up. So that way, I mean, I'm not too worried, and they have invested in a lot of these capex. And yeah, this is a very capex intensive industry. And whenever a customer will order, the Rico has to put up new capex. So these are some of the uh, products: HPDC line, high pressure die casting, then ferrous casting, machining. Machining, they are doing around 80% utilization. This casting is the place where they are not able to increase their utilization till now. And that's the thesis, that in the next 2 years, they are going to improve this utilization drastically, which will improve all the metrics and the part number. So in machining, 120 die casting. Subsidiaries, interesting to note, Rico Fluidtronics. This is part of the PPTs as well, Jinfei will. And then there's another arm which is like into defense things. They make right now some shooting ranges, but historically there has been also discussion in the annual AGM as well as in the conference calls regarding fuses. Yeah. And they are already empaneled to a lot of these uh, Indian government business factories. So management guidance is wait, I'll open my sheet once. Okay. So what do we have? So we have sales. Let me expand it a little bit. So your sales in FY25 was 2212, 2000 crores. Well, the management has been guiding that by end of FY26 from Maruti side and others, they have an assured order of like 45-50 crores a month. So around add another 200 to 50 crores and also some railway orders. So they should reach FY26 run rate at 2650 crores, and FY27 they should reach a 3100 crores. Right? And as I said, I mean, the FY25 utilization has been 9%. FY26, we are expecting around 10%, but even if we ignore FY27, once they reach like this 3,000 crore mark, their EBITDA levels will go to 13%. And other income is like 10%. And then they have a huge debt. So right now it's around 697 crores. But every year they are intending to pay off like 50, 60 crores every year. So 10% of the debt they'll kind of pay off every year. That's been their goal because they want to reduce the metric. So if I take that debt, I mean, you have an interest of around 50 crores, and then depreciation. I'm just taking a number like 100. So if you remove all that, PBT on a PBT level, you move from 55 crore to 262 crores. So that's kind of like a 5x jump in a PBT level. On a EBITDA level, it's around double jump. Yeah. And yeah, I mean, other than that, and then there you have PAT, you have the tax rates, 29%. So there you're going from 20. So this quarter it was 50%, but on an average in the long term, you'll see like 29%. That's what the management guided. So you go from 21 crores to 186 crores. Uh, I mean, I've assumed a lot of numbers, but directionally, this seems like a business where, if at all a transition happens, the entire benefit will significantly flow down in the bottom line to the bottom line. Yeah. So that's more important. Just a sec. Did I miss anything? No. Okay. And FY30 aspiration is that we can go to 5,000 crore, and whatever capacity that they have, that'll be enough from the land point of view, enough for them to reach that 5,000 crore number. They want to aspirationally be in that 15% margin range, mainly because uh, they have orders from railways. They're getting approved by RDSO, as well as uh, you have orders from defense. So if they get fuse business, or they're also in the BrahMos project, by the way. So they want to be aspirationally in the 15% margin range. And so the interest, again, 36% because they're reducing. So I've just taken a 10% of that. And and calculation wise, that's what's coming, 8.5% of the debt. If they're reducing 10% debt from the cash flow, that's how we get. So, I mean, you fall to a PAT of 442. So that's kind of like a 10x PAT jump in 5 years, right? So that's very interesting for me. And but okay, we have to trust on the management, but directionally, I think this is the bottom of the business. Yeah. So if you look at what is the upside that you have, right? Let's just look at it like this. So your market cap in FY26 is, say, for example, around FY25 it was 15. Where did I make a mistake? Yeah, so FY26, say it's 1460. I think that's an older number, but say it's 1460, and you have an EV of EV you calculate using EBITDA. So EBITDA 265 in FY26. That's what we are expecting, and you give it a 8 times EV EBITDA. So you get an EV of 2120, and from there you subtract the debt, because market cap EV is basically market cap plus debt. So you have a debt of 660. So if I do that, I kind of get a market cap of 1460. Now fast forward to FY27, because your EBITDA is going to double to around 403. So that this number, EBITDA FY27. And you again take a 8 times EV EBITDA, because that's basically the base. I mean, nobody will sell you below that. And this business is not dying. I mean, they have enough land to pay off all the debts. So again, over here, you do this, you get a market cap of 2630. Again, same process. And if I take EBITDA of 6,000, EBITDA of 750, when in FY20, FY30, you generate like 15% on a 500 crores top line, your EBITDA becomes 750 crores. So 750, and then again your EV becomes like 6,000, and you subtract it, you get a 540. So, I mean, from an EV point of view, my market cap can jump from 1,000 to, so 1,400 to almost 5,000, roughly 6x upside, sort of, yeah. And if they are able to execute in a very short time, you're going to see an 80% jump, and then till FY30, it will be like a 40% figure. So that's kind of good. In FY26 and FY27, you can see like 80% jump if they are able to execute. From a PE point of view, currently FY25 was a 50 PE, because again it was inflated because a lot of numbers were very depressed. FY26, I'm taking a PE of 25, and the PAT that they had was that I expect is supposed to be 84 crores. So market cap, I mean, just multiply these two, get like a 2,000 crore top line, and just say, uh, yeah, 2,000 crores. So this is the upside that they have. I mean, let me just quickly. Tup, 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 tup. So a 44% upside even from here. And then FY27, that's where all the magic happens. If they are able to deliver, that's like a 155% CAGR because I mean, sorry, no, that's a direct upside because it's not like, yeah, 155% upside. And then if I take FY30 from FY26, so 4 years, you get a 57% CAGR sort of an idea. So that's really attracted me, and we are not taking some egregious valuation over here. Maybe I feel like optionalities are your defense and your railway plays, which can bump up the P to say a 40 P, or maybe the EV EBITDA goes to like a 14, 15 EV EBITDA. If everything starts firing, then you can see a phenomenal upside. But, I mean, even by the numbers, it looks pretty good. I'll go back to the presentation. Okay, so management says that they have already have 7,000 worth annual order, which will be present in FY27, and top line can reach 3,100, 3,200 crores. And this is from the commentary, 720 crores of peak sales from Maruti, Tata, Toyota, and Norbemse, which is into the railway, Askin GSM, and all of that. And this is from the ER. And railway and defense orders are also high margin products. Okay, so this is basically the background. And why this thing happened? Why did the company go to such low levels of realization where they had in FY 27, 21 or 22, 8 to, yeah, 21% margin or 22% margin? My view is that, just a second. Yeah, I mean, there's some red flags or concern that management had guided a lot of things, but it didn't realize. But in my point of view, it's not due to their own fault, but their OEM challenges. So, for example, in 2020 there was a COVID year, 21 there was a COVID year, 22 they had guided for something, but 22 you had chip shortage. 23 also you had chip shortage. So they kind of missed a lot of targets. And 24, couple of their segments didn't run up. So they had a lot of investment done for your BMW EV as well as Nissan EV. Those plants are sitting idle for 6 months and 1 year, but the fixed cost has already been done and depreciation is taking place. So FY24 they had that issue. Currently they're facing an issue with rare earth magnets. So that's why this quarter 40 crores of top line got shifted to next quarter. Yeah. So these are some of the challenge that is constantly happening with the company, and that's probably a nature of the business. So I mean, slowly they'll move out of it. But I see this company in a transition or an inflection point where they can turn and do significantly better. Yeah, these are some of my calculation why I'm taking that 8.2. So in a 3 year, or even if you look longer term, I mean, max it was like median is 6.8, 10 years it's 7.6. So roughly I say that eight times EV EBITDA is a good number to be. It can fluctuate between 11 and 6.5, but I think 8 is a good number to be. And on a P basis, I think 20 is again a good number. 10-year median is 20, but it can again fluctuate. But P is a very noisy number. And so, yeah. So, yeah, I mean, looks good from an upside point of view. Thank you.